Welcome back to the channel. I'm Darren Farwell of the Farwell Group with Scotia Wealth Management. This series was created to help you find financial freedom. In each video, we discuss topics relevant to you and your life. Be sure to subscribe to our channel and click the bell below to receive notifications of new videos. If you have any questions or topics you'd like us to cover in upcoming videos, be sure to comment below to be featured. Now, let's dive in. I speak with a lot of young investors, and understandably, one of the questions that I get over and over and over are, what are the important things to think about as I get started saving and started investing? Well, of course, it's a great question, and the fact that they are asking that question is in itself really important. There are, of course, lots of answers to it, but I'd say there are 5 things that our young investors should consider as you start saving and you start your investing career. I'm going to go from the top. Number 1, how much should you put away for investing? Well, of course, the simple answer is you should put away as much as you can. But I know from speaking to a lot of young adults that things like paying back their school loan and starting to pay a mortgage and paying for their dog's vet bill and in many cases starting a family, that's all really expensive stuff. There doesn't feel like there's a lot left over to do savings. I would encourage you to be creative. Think creatively about ways that you can take that limited budget you have and use it most effectively so that you can actually save a bit more than what you were thinking. Pre-authorized checking is a great way of doing that. You save off the top so you don't even notice you don't have it. There are often company plans that you can use that match the amount that you're investing, so at the end of the day, you're investing more. So work a little bit at how much can I save, and be creative when you're thinking about that. Number 2, how much might you need? A lot of the principles of investing are about what's the time horizon. You've probably heard that term over time. What's your investment time horizon? What's kind of a technical way for saying, when are you going to need this money? Because if you need the money 6 months from now, you can't take much risk because the stock market could go down anytime. You don't want to have less than 6 months than you started with. Time horizon is critical. So spend some time thinking yourself, as a family, however it works, with just when are you going to need the money? Are you looking at buying a house in 3 years, so you're going to need some down payment money? Are you saving for an important vacation? Do you need to buy a new car? All of these are things to be thinking about when you think about what's the time horizon for your money. Because the longer you have available to invest the money, the more you can take a little bit more risk. And the more that you can afford to take a little bit more risk, you have the opportunity of earning higher long-term returns. So it's a critical conversation. What are you going to need the money for? And by the way, different pools of money can have different objectives. You can have one pot of money that you know you're going to need 3 years from now, a different pot of money that you might need 7 years from now, and another pot of money that you feel is going to be invested until you retire. Those are the kind of things to think about. Number 3, this is one I hear a lot. We see lots about it on television commercials as well. Should you do it yourself? That's a complicated question and has a lot to do with who you are personally, what your skills are, what your level of confidence in investing is, who you know that could help you out within your own circle. But one thing that I do know from, well, I started in this business in 1986, so I've seen lots of people managing their money over time. And I would agree with what they say in the investment industry, which is the biggest single mistake investors make that hurts their long-term net worth is selling good quality investments at a bad time. Who would do that? Who would sell good quality investments at a bad time? The thing about bad times, it's not about math anymore. It's not rational thinking that's controlling your thoughts. It's, oh my money's going to go to zero. Because when the stock market is bad at times, it can be really bad. You can be down 30%, you can be down 40%. And for many people, to see the value of their investments go down 30 or 40% causes them to lose sleep. If they start losing sleep or get overly worried, what happens? Emotionally, they sell. And when you sell good quality assets in a bad time, you're not going to make good long-term returns. So if you feel the confidence, if you have the knowledge, the confidence, the circles you work with that will allow you to avoid making the big mistakes in investing, then perhaps you should do it yourself. But I would actually interview a professional and then make a decision whether or not you feel that professional will be able to add enough value so that net of that professional's cost, you're better off over the long term. Because at the end of the day, it's not about the firm that's investing your money, it's about your long-term net worth. Number 4, this is one of my favorites. Have a game plan. I want you to take a moment and imagine what you'd like the next 30 to 40 years of your life to look like. The foundation of a financial game plan is imagination. If you can dream it, you can achieve it. It doesn't matter how young you are or how old you are. Having a game plan is a critical step in achieving long-term goals. So even if you just started saving, I would say get yourself a long-term financial strategy. Even if your situation is complex, it doesn't have to be complicated. With a written game plan of your vision for the future, that's going to help you get there. Number 5, investment success happens over the long term. We see a lot going on in the world right now. We've had pandemics, we've got war, and these are overwhelmingly large issues. But what is fascinating when you look at the history of the market, when you look back over the course of 20 or 30 or 40 years, these events, as important as they are today, from an investment perspective, from an average annual rate of return over that course of time, is relatively insignificant. The key to success for investing and creating wealth is to have your money invested for the long term and do what you can to avoid the short-term noise. That doesn't mean invest and ignore. You should have a process to check in on your investments to make sure they're still on track with why you bought them. But beyond that, be focused on the long term because that's what's going to create your wealth. For more information, be sure to check out the resources we've included in the description below. Tune in next time as we share more tips and comments. And don't forget to subscribe and click the bell below for notifications for future episodes. If you'd like to get in touch, please email us at the address below in the description. See you next time.